Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited, and here is your weekly technical analysis of the Chicago soybean complex. Chicago soybeans. I have recently been away attending domestic and international technical analysis conferences and representing ADM at such events. So when I've come back to look at these daily charts, it is in many ways with a fresh set of eyes. Here's what I can see here right now. The key recent pattern had been the ascending triangle formed over late June through to late July, and is highlighted in dark blue on my daily chart. The break lower in late July saw a move down to the primary target of 1364 with some ease in just over a week. The harder to reach secondary target X in the 1278 zone, well, that has been harder to reach, but target X was finally reached 2 weeks ago. In the process of heading lower, the market created a late July to late August bearish shift pitchfork, which you can see highlighted in purple on my daily chart. This pitchfork had been brilliant at showing the bearish angle of attack of this market from late August until last week, when the market broke up over the upper time, and that's currently at 1287. The reason I said broke rather than breach was that last week was a weekly key reversal up, and if you are going to break a pattern, then there is no better tool than a weekly key reversal, apart from perhaps a monthly key reversal. Anyway, this break higher is now approaching its first real test overhead, and that is the declining short medium moving average, currently at 1337. This is not that heavy a resistance, though it did do a good job of capping the market back in late August, so there is some caution about it. However, more forceful resistances lie ahead, notably the recent 50% Fibonacci line at 1349 and the slowly rising long moving average, currently 1409. And this is before the market hits a band of congestion overhead between 1378 to 1409, a band I've spoken about in earlier times, as it contained the base of the late 2022 descending triangle at 1378 and the lesser Fibonacci line at 1409, and now also the slowly descending long moving average above, currently at 1409 also. Chicago soybean meal. The key recent pattern here, much as in the case of soybeans, had been the mid-June to early August ascending triangle, which is highlighted in bright red on my daily chart. The market eventually broke down and out of this pattern, reaching a primary target in the 408.60 zone, and still leaving a harder to reach secondary target X1 down at 381.40. The first attempt down at 381.40 failed back in mid-August, but then 3 weeks ago, a sharp move lower with a combined bearish opening white Mariposa and bearish engulfing pattern managed to reach target X1. Indeed, the market overshot the downside and eventually was halted by a congestion band between 368.80 and 363.70, where prices consolidated. Now, in the process of moving lower, the market formed another pattern, a late July to late August bearish shift pitchfork, which you can see highlighted in purple on my daily chart. This pitchfork gave a brilliant indication of the bearish angle of attack from late August until last week. Now, there is no weekly key reversal up here last week, as we saw in soybeans, but that doesn't mean it was immune from its effects. No. We saw this when prices punched up through the upper time, currently at 376.80, of this bearish pitchfork. Prices consolidated at the start of this week, but have since moved high, overcoming the first three overhead resistances of the declining short medium moving average, currently at 396.40, the medium moving average, currently at 403.40, and the 50% Fibonacci line of the October 2021 to March 2023 move at 403.60. These are all now supports. Overhead, we have the lesser Fibonacci line at 415.5 and the congestion highs of late August between 418.90 and 419.70 and then 423 even. But this time without the added pressure of the moving averages which were there back before. No, we really start hitting some serious resistance up around the lesser Fibonacci line at 425.90, because it would seem that if prices were to get that high, then the addition by then of the declining long moving average, which is currently 428.30, could reinforce what would seem pretty light resistance. Finally, this brings me once again to my final point, which I raised 20 weeks ago, and which I will keep raising for the rest of this year, at the very least. You see, on my long-term monthly charts with 3/4 of the year gone, 2023 is set to be possibly an annual key reversal. Thus, if we were to close on New Year's Eve either above 471 even or under 399.10, then we'd be on. Anything in between and would have a lesser outside year. Right now we're looking at an annual outside year, but we still have so many months still to go. Chicago soybean oil. The original key pattern here was the late November 2022 to early June 2023 descending wedge pattern, which still has some influence, and I will go into that shortly. But first, the more recent key pattern here had been the late June to mid-August head and shoulders top, which had an extension or handle to it. You can see the neckline highlighted in dark blue on my daily chart. The primary target for this pattern was in the 60-38 zone, which was achieved in early September, and with a secondary harder to reach target X down in the 56-74 zone. 3 weeks ago, the secondary target was achieved, but in the process of heading lower from the head and shoulders top, the market made a bear channel stroke descending wedge pattern, which, though not highlighted by me, you can still see on my daily chart. This market, much as soybean meal, was not immune to the weekly key reversal up in soybeans themselves, and turned a test lower early last week into a break up over the trend line, currently at 53.15, of that bear channel stroke descending wedge pattern. However, the move higher here has not been as successful as we have seen elsewhere. Indeed, prices seem to be trailing along the breached but not broken upper trend line, which leaves a big question mark on this market. Immediate overhead resistance is from the February 2013 high at 54.15, but is not that strong. Whilst better resistances start at the 50% Fibonacci line of the March 2020 and April 2022 move at 56.34 and rise up in stratified layers up to 59.44. Within these stratified bands you will find the slowly declining long moving average, currently at 58.33, the August 2011 high at 58.59, and the recent late May to late July 50% Fibonacci line at 56.91. Meanwhile below, well, we don't have that much support bar that descending bear channel stroke descending wedge pattern, and that really isn't that great support anyway. We don't really have much support until prices start approaching, as they did earlier in October, the March 2013 high at 51.26. Now finally, and this refers to my earlier statement about the large descending wedge pattern seen earlier this year. I said the following some 16 weeks ago, and have also on every opportunity since, and I quote, "I would consider this descending wedge pattern may, just may, have lately morphed into a possible scallop pattern," end of quote. Now, I will not expand on this idea any further at this time, as it's still early on, but the recent market decline fits in with this idea, though the expectation of it would be to eventually witness a fall down to the area of the May and June lows, which is possible but may be a little hard to see right now. However, I do wish you, and also me, to just keep this in mind, especially following the recent actions we've seen. It may all fall well into such a pattern idea.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and the back of this broadcast. Copyright is Eddie Topic and ADM Investor Services International Limited. And here comes the final important bit.